Have you ever heard of these investors called dividend stock investors? I'm actually one of them. I invest in companies that pay dividends like McDonald's. Happy Halloween, everyone. This is the McDonald's Halloween Happy Meal. I invest in dividend companies because I receive cash flow on a regular basis in the form of dividend payments. I earn this cash flow while I sleep at night. I don't have to do anything for it, and I can use the cash flow to pay bills. That's why I'm a dividend investor. There's a whole class of skeptics out there, however, that say dividends, they don't really matter. They say that basically dividends just force you to sell shares more or less on a recurring, regular schedule. They say there's really no difference if I were to receive dividends versus actually just taking the shares that I own, selling them off bit by bit to pay my bills. I want to go into some theory today. I want to share the 3 pillars of how I value dividend stocks or stocks in general, and I want to explain why these skeptics are wrong. And so I want to go into my theory behind dividend investing and why dividends are so powerful, and it's such a technically sophisticated and powerful tool that so many investors get completely wrong. Get ready, everyone, for a really exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So shout out to all of you who remember the whiteboard. It is back. I am kind of in the corner again, but it's a new home. So different corner, new home. Shout out to everyone who's been here since the early days of PPCE. And if you've been here since the early days, please go ahead and drop a comment below to share your favorite video from the corner days on my channel here. All right, let's jump into the 3 pillars. So what you see here on this whiteboard is first the balance sheet. I like to value companies based on their balance sheet because it gives me a snapshot basically of their bank statement. When I look at their assets, I look at their liabilities, I subtract liabilities from assets, how much equity is left. I get an understanding if their bank account, if you will, has any value at all. Some companies, their bank account is meaningless because the assets and liabilities cancel each other out. Some companies, the liabilities are greater than assets, so it has a negative book value or negative shareholders' equity. And so this pillar, it's kind of a net detractor from those companies. But as you can see here, I've got assets and I put a box around cash. This is really, really important to earmark and remember because I'm talking about dividends today. I want to come back to this, but there's a reason that I put a box around cash. What are some other examples of assets? I've got property, inventory. What are some examples of liabilities? Liabilities could include debt, short-term debt, long-term debt, could include accounts payable, so on and so forth. The difference between the two is the equity. Basically, a company that has a lot of equity, this pillar will have meaning in the company's valuation. A company that has a ton of equity, a really sharp balance sheet, a really strong balance sheet, it will thrive in this pillar and it will create a lot of value. And that's just one of the components that go into the underlying value of the entire company that helps dictate what share prices should be valued at. Now, I want to go on to the next pillar. The next way that I look at companies, in addition just to their bank account statement, their balance sheet, is the income statement. And what the income statement does is it gives me a sense of how good the business is, how profitable the business is at driving profits, of basically at the bottom line earning net income that can be pumped over into the balance sheet to make the balance sheet even stronger than it is right now. And so we've got revenue at the top of the funnel. You get cost of goods sold, which brings you to your gross profit. If you take your gross profit, you divide by revenue, you get gross profit margin. You've got SG&A or general administrative, sales general administrative type costs. If you subtract that out from the gross profit, you get operating profit. Operating profit divided by revenue gives you an operating margin. If you go further down the income statement, you've got taxes, interest. If you subtract those out of the operating profit, you get all the way to the bottom of the funnel, which is net income. If you take net income, you divide by revenue, you get net margins. At the end of the day, if you take the net income, you divide by all the shares outstanding, you get earnings per share, EPS. And basically, those companies that have really strong margins and that are really good at driving a lot of revenue, a lot of earnings, huge earnings per share, that's really important because that's a snapshot into the operations of the company. We have a snapshot into the balance sheet or the bank account of the company, but here we have a snapshot into the income statement, which is really the operations of the company. And at the end of the day, as an investor, whether it's dividend stocks, whether it's non-dividend stocks, I am buying thriving businesses that are alive. They are operating businesses and they are in business probably to serve some greater good for humanity, hopefully in one way or another, and to employ people. But more importantly, quite frankly, is to drive a profit for shareholders like myself. And so those are two pillars. And when I look at both of those pillars, they both go into the company's valuation, but that's not enough. That's not enough. We need to look at some subjective and some other factors as well. So I have a third pillar, and that's really what I like to call business trajectory. I like to look at things, well, are the earnings growing? Because this income statement, it can look really robust, but if the bottom line EPS is not growing over time, well, I'm going to discount the value of this operating business. This operating business doesn't matter as much to me if it's not a growing business. I look at things like margins. If my net margins aren't really strong, let's say if my net margins aren't 15% or 20%, it really differs by industry. A regulated electric utility, for example, is going to have much different operating margins and net margins than a company like McDonald's. McDonald's has really strong margins, quite frankly, because they franchised out a lot of their business as well. So they have a complex income statement and a complex business model, but you'll see very strong operating net margins at a company like McDonald's. So it's very industry specific, but basically what margins give a sense of is, well, how strong is the business? How much of a competitive moat does it have? How difficult would it be if they hit one bad quarter to keep the business on the right track? Because we all know if a company is more profitable, has better margins, it's going to be more difficult to derail a business like that than a business that's barely squeezing by. It just has a few percentage points margin. If one little thing goes wrong, they could be losing money instead of earning money. And if they're losing money, we know this second pillar doesn't mean a lot when it comes to valuing a stock. A company that's losing money, quite frankly, in my opinion, is only going to be worth what it really is on the first column, which would be their book value. And quite frankly, there's companies in real time right now, like McDonald's, that are hitting 52-week highs. They're doing really well despite a bad economy, and they're doing well because they have a strong balance sheet where, quite frankly, they're carrying property at purchase price, but also they're growing the business. They just increased the dividend because the business is growing so quickly. But you have other companies that made some, I don't know if it was bad bets, but maybe they're, I would say, before their time. Like Meta, for example. It's a little bit before its time when it comes to the metaverse. The stock is tanking. It's tanking because the income statement, it's not looking as good as investors would like it to look. They're making all these investments. They're using cash, for example, to go ahead and invest in the metaverse, but it's not translating just yet into revenue and net income. And so we want to look at things like earnings growth, margins. I look at margin expansion and contraction. A business where the margins are growing, that will give it a premium valuation versus a business that's in decline where the margins are shrinking. We see a lot of businesses with margins shrinking now because the input costs are going up due to inflation. And so businesses that can pass along inflation to the customer, like McDonald's, they are thriving. They are at 52-week highs because the businesses are so strong. So some of this business trajectory certainly is playing into how McDonald's is performing. I look at things like just the overall economy. The economy as a whole can cast a shadow on the stock market, or it can cast a tailwind, if you will, on the stock market. And there's certain companies right now, because of where the economy is at, maybe they have a lot of debt that are having to refinance debt at high interest rates. Those are things to keep in mind. That's a business trajectory item where it could devalue the stock. I look at things like competitive moat or lack thereof. Strong margins generally mean competitive moat, but I also look at brand stickiness. A company like Apple, for example, has a brand stickiness. It's one of my largest stocks. I'll link in the pinned comment below. I just did a video on my top 5 largest stocks. You can check it out there. Apple rounds up the bunch at number 5. I look at things just like risk. There's companies right now that have a lot of risk, and that devalues the company. 3M, while these post-it boards hopefully don't have a lot of risk, there are other risk factors at the company right now, like pending litigation, and so that company has a lot of risk. That takes the overall value of the company, even though they have a reasonable balance sheet, even though they have a strong, stellar income statement. The risk factor dings the whole value of the company over at 3M. And so that's why all 3 pillars are important. I look at low debt versus high debt. Does it have low debt? That's going to increase the value of the company. Does it have high debt, especially in an environment right now where interest rates are high? That could take down the value of the company. And so an investor could look at these 3 columns, could apply percentages to these 3 columns. Ultimately, this is how a business is valued. This is obviously very high level. Each of these could be a book, but I am just trying to summarize it here on YouTube. But this is how I look at investing, and whether a stock pays a dividend, whether it doesn't, this is how I arrive at value in terms of understanding what a company is worth. Now, I want to talk about dividends because this is so important. I'm going to go back to the root question at the beginning of the video. At the beginning of the video, I was saying that some skeptics out there don't like dividends because when a company pays a dividend, it does notch down in share price. And they're saying, well, I could have just sold shares and got into the same result. I want to explain why not. So how do dividends work? How do they work? Well, first, in the United States, dividends from companies like Apple or 3M, for example, they typically pay them quarterly. McDonald's too. The way it works is they're going to declare a dividend. They're going to say, hey, we're going to pay a dividend. Companies like McDonald's, they tend to increase the dividend each year. They just increased the dividend in a really strong rate just recently. And once they declare it, they're going to say what date it's going to be paid out, so on and so forth. But the first date that's important is the ex-dividend date. On the ex-dividend date, that's the date, generally speaking, when you buy the stock that date, you don't get the upcoming dividend. But if you bought it the day before, you do get the upcoming dividend. And so typically on the ex-dividend date, the share price drops typically by about the dividend amount. So this is what the skeptics are saying. The dividend, it's not magic money. The dividend, it's not added value. It doesn't come out of thin air. And they are true in what they say, but they take it too far in terms of the conclusion that they're making. And so I'm going to get there in a minute. Then there's record date. The record date, it typically comes a day or so after the ex-dividend date. It really matters on weekends as well. Basically, if you own the stock on the record date, you're going to get the payment on the payment date. The reason that the record date is slightly after the ex-dividend date, to my understanding, is when you buy stock, typically it takes about 2 days for everything to settle. And so if you buy it the day before the ex-dividend date, it's going to be kind of settled by the record date. But if you're buying it on the ex-dividend date, it's not going to settle in time for the record date, and so then you're not going to get the upcoming dividend payment. And then there's the dividend payment date. And this happens like clockwork every quarter for the types of dividend stocks that I own. Again, this is technical. It doesn't matter that much. I generally just average into dividend stocks. It doesn't really matter to me, hey, am I getting it for the X date or before the X date or not? No, I just buy in. I average in because I'm buying for long-term cash flow. But why this is important is the skeptics say, okay, on the X date, it dips in value. And it's true, but the key thing that I want to point out on this slide, if you will, or this sheet of paper, is where does the dividend come from? It comes from cash. It's not a stock dividend, it's a cash dividend. When I receive the dividend as a shareholder from McDonald's, do I have to lose my percentage allocation that I have to their property, which is carried at book value or at purchase price? No. Do I have to sell off any portion of my percentage ownership in their income statement, their thriving operating business? No. Do I have to sell any portion of my kind of exposure, if you will, to their margins at the business or to their low risk profile or to their competitive moat, their world-class brand? No, because what McDonald's is doing is they're paying this dividend out of the least valuable thing that they have as a company, in my opinion, and that is cash. Because cash, it's just a currency. It's just a medium of exchange. I would never want to sell the goose that laid the golden egg. To finance my bills, to pay my bills, buying quality stocks, holding them for decades, sitting back, letting the magic, the compounding do its work. The whole reason I'm doing this is to invest in golden companies. I don't want to sell that system. What I want to do is use the least valuable thing on this entire sheet, which is the cash, and have it funneled to me on a recurring basis, no matter where the stock price is at, so that I can use it to pay bills. Now, let me contrast that with someone who owns a stock like Meta. Not only is Meta going down now, and I don't want to pick on Meta because, quite frankly, I actually believe that some of the bets they're making will pay off in the long run. They don't pay a dividend yet. So if someone invested in Meta, let's say they were like pre-IPO even, they bought it really early, hey, well, in that case, they probably outperformed most McDonald's investors. But just looking at it as an example, what happens with a stock like Meta if you want to use it to pay bills? Well, you have to sell a share, or you have to sell a fractional share. You have to sell off a portion of one's holdings to pay the bills. Well, what happens when you sell shares? You're not selling just the cash. You're selling everything on here. You're selling the entire worksheet. You're selling the operating business. You're selling the properties. You're selling their intellectual property, whereas Meta might not own a lot of physical properties. Their IP, their trademarks, their platforms, their code, it's worth a lot of money. But if I have a bunch of shares of Meta and I need to sell a few of them to pay my bills, well, I'm selling not only the cash, but everything else along with it. And so I'm essentially selling the goose that lays the golden eggs. But again, with McDonald's, if I can avoid selling shares, I can just wait for my dividends, wait for them to grow, use those to pay the bills. I'm not selling any of this, not selling any of this, none of this. I'm just selling this. And so that is why, just as a mechanism, dividend stock investing is so amazing. But it gets better. And so I have a little bit more I want to share with you all before I wrap up the video today. So check it out here. The title of this one is just living off of stocks. And so again, dividends, there's two ways to live off of stocks. I mean, I'm not going to cover day trading here or things like that. I'm kind of keeping it simple for illustration purposes. But someone who wants to live off of stocks is going to pursue one of two avenues. Typically, someone is going to buy stocks, use the dividends, and use those to pay bills. Or they might buy a stock, wait for it to appreciate, or just hold it over time and sell off a few shares here and there, hoping to have those cover the bills. And so dividends, again, it only uses the cash portion of the system to fund one's lifestyle. With selling shares, the investor sells the entire business, including the goose that laid the golden egg. And again, cash, it's just a currency. The business, it's forever. As an investor, the least important thing on the previous slide to me is the cash. It's important, mind you, and it's especially important, the interaction between the cash on the balance sheet and the income statement. I want us to see the income statement throwing off a ton of cash over to the balance sheet. That trajectory is more important to me. But the raw cash on the balance sheet, if I need to get paid, I want to be paid in that. I don't want to be paid in selling off my percentage ownership that I have to a thriving business, a goose that lays the golden egg. But it gets even more interesting. Stocks go up and down over time. Over long periods of time, they'll go up and to the right, but they generally go up and down over time. A dividend is typically paid quarterly. The benefit of a dividend is it does not force an investor to sell shares of a business at a suboptimal time. And so here's the first dividend gets paid at this peak. I guess if I were to sell shares here to pay living expenses, that would actually coincide with that. That would be a good time probably for the counter argument for the selling shares. But more often than not, share prices are down like this. And who wants to have to sell shares down here to fund living expenses? No one. No one wants to do that because it's selling shares and it's selling exposure to a business, to an operating business at a time when Mr. Market is just unhappy. The business could be doing really well. It could be super, super thriving. It could just be Mr. Market is a little bit moody. The stock is down, but oops, I need to pay my gas bill. I have to pay my electric bill. Uh-oh, I have to sell it down here. That would be terrible. But the benefit of a dividend, by contrast, is no shares are being sold. I'm not selling the system. I'm not selling the goose that laid the golden egg. All I'm doing is taking cash from their balance sheet into my pocket to pay bills. And again, that is the least valuable thing at the company. The most valuable valuable thing is their ability to generate more of that cash so I could get paid more frequently like McDonald's is doing right now. And so, of course, there are counter arguments and there are nuances to this. For example, a business needs to be able to reinvest in itself. And so it's important with dividends to have world-class companies like McDonald's that have reasonably low payout ratios. So yeah, they're paying out some of their cash to people like me to pay our bills, but a lot of the cash is being retained at the company to reinvest in the company, to expand upon the company, to make acquisitions, to improve upon operations. Because of course, in this world of investing, typically a stock, a company, it's either growing or it's shrinking. And I want to be invested in companies that are growing because that falls into the third pillar on the prior slide, that companies that are growing, that is their trajectory of their earnings. And companies are valued based on that. So that's really important that companies are also retaining some of their cash to reinvest and to grow the business as well. And so I have a few things that I want to close out with. Key. This is so important. I want to give a shout out to one of my friends, Scott. He's from the Bay Area. We had a meetup early on, San Jose, and he brought up this point that, like, Ian, I'm an investor. I invest in great businesses. It just so happens that a lot of those great businesses happen to pay a dividend. And that's so important because a lot of the skeptics who are saying dividends don't matter, dividend investing is no good, they say people like me, we just kind of buy dividend stocks without really taking into account the business. We're just buying it because it pays a dividend. No, first and foremost, I like to buy great thriving businesses like Scott. But the key is I'm not just going after stocks that pay dividends. I'm not just going after stocks, oh, I have to buy this one because it pays a dividend. No, I buy great thriving businesses that happen to pay dividends, happen to increase the dividends over time like McDonald's. But what's so funny is most of the best companies in the world that I've found, at least, by coincidence, they do pay a dividend. And that's why I'm a dividend investor, because the best thriving businesses, they have so much excess cash flow that they have so much money to pay out the dividend. And so that's why I'm a dividend stock investor as well. In my core dividend stocks, yeah, they're the best companies in the world. And coincidentally, they happen to pay a dividend because they're the best companies in the world. And there's another point here. Dividends don't equal stock dividends. Cash dividends don't equal stock dividends. There's a concept of a stock dividend, or basically a stock split, if you will. But some companies in the olden days, they used to do these like stock dividends, like for every 100 shares you have, you get one more. And a lot of people who contradict dividends or who say they're no good, what they tend to say is, well, it's dividends, nothing special. It's just, hey, it's like selling a share, like getting a stock dividend. No, a stock dividend is not the same as a cash dividend, because mind you, if I have 100 shares and now I have 101, the total number of shares outstanding goes up. I have the same percentage exposure to the business. And if I sell the one share I got as a stock dividend, I'm selling off exposure to the goose that laid the golden eggs. But cash dividends, by contrast, again, it's funneling from the cash on the balance sheet into my pocket. They're selling off the least valuable thing that I can use to pay my bills. While the thriving business, I still have the same percentage exposure as an investor to all of that. And I never want to sell the goose that laid the golden egg. By the way, put in the comments below, how many times did I say goose that laid the golden egg in the video today? It's probably quite a few. If you enjoyed the video, everyone, please go ahead and click the like button. It means the world to me. I want to get out there on YouTube. I'm getting back to my roots. I hope this video is a fun one for all of you. I like to see you all in the comments below as well. I try to respond to a lot of those comments. The subscriptions mean the world to me as well. I love you all. Before I go, in terms of a full disclosure, I am long 3M, ticker MMM. I am long McDonald's, MCD, and Apple, AAPL. I own those stocks in my personal dividend stock portfolio. Also, before I go, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's for your fun and entertainment. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market, and I'm just sharing my journey for everyone out there to see. I love you all. I'll see you in the next dividend stock investing video.